Welcome to today's webinar. Today we are joined by Carl Croonan of Ohio National, who's going to give us a scintillating discussion on indexed whole life insurance. This is brought to you by NAIFA's Advisor Today, where we work to live, work, and give and tell the holistic story of the advisor, giving you the tools, the education that you need so you can be the best advisor that you can be. With no further ado, Carl, we're going to turn it over to you. One housekeeping item for everybody who's joined us today. Carl has a full slate here to give us, so feel free throughout the presentation to ask any questions you'd like using the Q&A box, and we'll get those answered in real time. And if we should run out of time and your question is not answered, we'll make sure that we get that answered and we'll put it into the follow-up email along with the survey link so you can give us a feedback as to what you thought of today's webinar. So Carl, thank you for joining us. We're delighted to have you, and the floor is yours.
Thanks, Suzanne. I'm very excited to be here. Our 10-pay indexed whole life contract is a product that we rolled out this fall. It is, to my knowledge, the only indexed 10-pay contract in the marketplace today. And I want to spend a little bit of time talking about how we got there and what it does, and show you a couple sales ideas. If any of you have been affiliated with Ohio National over the years, you've probably seen me speak once or twice. You know I tend to cover my ground pretty quickly. John Grievous is on the line, as Suzanne said, to answer questions. John, just a quick shout out. If you think any questions are something that are particularly relevant to the topic as I'm on there, feel free to break in and if maybe we need to answer it for everybody because I didn't cover something well enough. But with that, let's get going. I of course have disclaimer slides, as any home office person is going to have, to make sure that you all know that I don't know what I'm talking about. One point on the disclaimer I want to be very clear on: our product is not currently available in California or New York. In New York, we are not licensed to do business. In California, we are. We are waiting for the state to get back to us on actuarial approval. We have form approval. It's been with them since June. It's a little bit of a challenge, as I think many of you already know, getting things through California, but we hope to have that fairly quickly. So I want to go back in time a little bit to when we were considering building this product, and we were thinking about interest rates in the United States, where since 2008 they've been pretty darn low. And what I've got here is the BBB U.S. Corporate Bond Index that I found on the Federal Reserve of St. Louis, and this is just the last 10 years. And you can see it goes up and down, up and down, up and down. But if you look, I think the mark that I put out there, 4%, is a pretty good line for what might have been the average over the last decade prior to. I think I pulled this around September or October of 2022. And so while we've had very high interest rates comparatively in the last few months, that hasn't been the case. And we were thinking about this product back in 2021 and tossing around some ideas about what to do with whole life insurance. Because our concern is, if you have a traditional dividend paying whole life insurance product, the performance of that product largely relies on the dividend. The dividend largely relies on the interest rate environment that you're operating in. And if you're operating in a 4% dividend environment on average, it's going to be hard to support an accumulation-based whole life contract for the next 30 years if you think that's where you're going to be in the interest rate environment. And we'd come to the conclusion that the Fed was pretty serious about their 2 to 3% inflation target, which means a 4% BBB rate is not out of the question for a long-term basis, even though right now it's considerably higher than that. We were also taking a look at what traditionally insurance companies invest in. This is pulled from Vital Signs. Many of you have already probably seen something along this. And this is just a bunch of the whole life carriers out there. And you can see that right off the bat, the number one investment for insurance companies, generally speaking, is investment grade corporate bonds. And I bring that up because of the prior slide. Why was I looking at BBB yields? Because that's what we invest in, BBB or better. And so BBB is kind of the high end of what we would be putting money into when you start talking about corporate bonds. And that's where the great majority of money gets invested to support insurance portfolios outside of the variable products. We also put money in mortgages. As my chief investment officer likes to say, those are a little bit spreadier, so you can get a little bit more money out of that, a little bit higher yield. Carriers will put various amounts inside mortgages. Of course, that typically is the number two investment, so that can get you a little bit more than what you would see out of the bonds. But overall, you can see over the last 5 years, the industry average portfolio, and this is pulled from the blue books that we file with our states every year. So this data is as of December 31 of 2021, because that's what Vital Signs uses, year-end data. You can see that yields have been below 5% for carriers for some time, and our 5-year averages are pretty low. So bearing that information in mind, the questions that we're asking ourselves is that given a decade more of low interest rates, that creates a challenge for insurance companies to achieve competitive products in their portfolios, even in the current increased interest rate environment, because we tend to hold portfolios that are 10 to 12 years in duration when you look at the assets that we own. And so just because we've seen interest rates go up for 9 months, that's very helpful. But it's a small percentage of the total portfolio. It doesn't move it all that much. We need them to stay up now for an extended period of time. And the question is, how long will they stay up, and will they revert to where they were before? So how can we provide products that both protect through death benefit and grow through cash value? And we were thinking about whole life insurance in particular, because we were seeing some challenges in the dividend environment. And we thought if we could link the interest that we're earning to the index accounts the way Index Universal Life has done, that could give us an opportunity. And there's some technical reasons why this type of product hasn't shown up in whole life before. And I don't want to get into those a whole lot. But there is an opportunity right now that hadn't been in the industry for prior years to make this kind of change. And thinking about that opportunity, we said this could be a place where we could be first to market. You could see the growth of an entire new class of product, just as you saw IUL back in the mid to late 90s when it was first created. It was a very small part of the overall environment at first, and now it represents a very significant part of the environment. We think indexed whole life can have that same sort of growth potential as we go forward. So that's what I'm introducing today. It's a 10-pay product that we call Prestige, because that's the whole life line's name, Index 10-pay. It has the guarantees and stability of a whole life product. So it's a 10-pay contract, so your premiums are guaranteed for 10 years, and then they stop. We cannot come back and ask for more premiums, irrespective of the performance of the product. It has a guaranteed death benefit. So if you pay those premiums, that death benefit's going to be there unless you pull money out of the policy. And then, of course, that changes things just like it would with any other whole life product. And it has guaranteed cash value associated with it. So we know that there's some level of cash value that's always going to be in the product, irrespective of the performance of the indexes that your client might choose to put their money into. But it does, at the same time, provide the flexibility and the potential of an indexed universal life policy. We have 4 different index options currently. That number could go up or down as we go forward. We have index and standard loans available. We have an overloan protection rider available, which you don't generally find in most whole life contracts for some specific technical reasons. But we can do that here that we could not do with our other products. And I think that potential to get money out using some of those other features makes it a very attractive policy in today's selling environment, where you see a lot of clients buying life insurance, not just for the death benefit, but also for the ability to accumulate assets and then pull them back out of the contract. So let's talk about how it splits up. As I said, 10 level premiums, that's part of that base design platform that is whole life oriented. They're going to be fixed. You can't pay more, you can't pay less. You can't pay for 10, you can pay for 9 years and then borrow against the 10th year or something like that if you wanted to, but we require 10 level premiums. So it's different than a universal life contract. It's very much like a whole life policy in that structure. It uses a 2% non-forfeiture rate. And I'm sure that many of you understand the importance of non-forfeiture rate in how a product is built. Just very briefly, this slide I think is very useful. Simply put, the lower your non-forfeiture rate, the higher the MEC and DEFRA limits for the policy. In other words, the more money you can put in before it either violates the modified endowment contract rule or it violates the DEFRA rule and it's no longer life insurance. And the higher the required premium is as well, because you're accumulating those assets at a lower non-forfeiture rate. So you still got to guarantee your cash value to endow. You need a little bit more premium for that. So what you see in the industry is, generally speaking, products that are designed for accumulation of assets and distribution, in addition to death benefit, will tend to have a lower non-forfeiture rate. Products that are more focused just on the death benefit in the whole life world tend to have a higher non-forfeiture rate. With a 2% non-forfeiture rate, that's as low as you go. So when I say we have a 2% non-forfeiture rate, what you need to walk away from the conversation with is, oh, they built it not just for death benefit, but also to accumulate assets for future distribution at some point in time. it serves that purpose very effectively. And then we have a guaranteed cash value that endows at age 100, just like pretty much every other whole life policy out there. I mean, here's a quick example of some other 10-pay contracts. We're at the top, and then I've got alphabetically 5 other carriers that sell whole life insurance. I do want to note that the top 4 carriers, ourselves included, use a 2% non-forfeiture rate. The bottom 2 carriers use a 3% non-forfeiture rate. And that means they generally are going to have lower premiums to have the same guaranteed endowment at $500,000. But you can see if you look at guaranteed cash in 10 years and 20 years and 30 years, in 40 years, the numbers are very, very similar. And in fact, in many cases, they're exactly the same. If you look at, say, 20 years, for example, we're at $399,870. Guardian is also at $399,870. Mass Mutual is also at $399,870. We're all using a 2% contract, and we're all generating the same guaranteed cash. And every one of these contracts is going to endow the guaranteed cash for $500,000 at age 100, 45 years after the issue date, because that's a male age 45 best class. And so it has that same exact feature that you would find with any other whole life contract. And there is no maturity age on the policy, like so many policies that are issued today. As long as your client's alive, that policy continues. Again, if we have some crazy invention that allows us to live to 135, then that policy is going to continue to 135 whenever that client passes on. Now, how does it look like an IUL? Well, you know how a whole life, when it comes to cash value, is kind of a black box. We credit guaranteed cash, and then we throw in this dividend factor. But trying to explain why the guaranteed cash is what it is, or trying to explain how dividends work to clients can sometimes be a challenge. This is a lot more transparent, just like an indexed universal life would be. Might look complex, but it also has that sort of transparency. So you can see, and you've probably seen something like this before. There's your premiums coming in. Before the premiums hit the cash value, we take out any premium loads and premium tax, and the rest flows into the cash value. Out of the cash value comes your cost of insurance and your fees, any disbursements the clients take. And then off of that invested asset, the money that gets allocated to the various indices of the fixed account, the interest comes back in and refills that cash value. So it's very transparent in the way it works. The cash, the premiums come in, you can see how much money it is, you can see those fees come out, you can see how the interest gets credited each and every year, and it's pretty straightforward in that respect. So if you start looking at current cash value instead of the guaranteed cash value, looking at those same carriers, this is what we have. And you can see, because we have different premiums, the best way to compare is using internal rate of return, which tells you what the rate of return on each premium dollar would have to be over that time frame in order to generate the cash values that you're seeing. And you can see the 2% contracts generally have a slightly lower internal rate of return early on. We're at 0.80, so we're kind of second of the 2% contracts behind 101.18 for Guardian, but we're, for the most part, all breaking even or a little bit better. The 3% contracts tend to do a little bit better early on, the 3% non-forfeiture contracts. When you go to 30 years out, however, you do start to see a switch. You start to see the 2% contracts because of that higher funding pattern, because of the lower internal costs, because you have lower net amount at risk, start to accumulating faster and faster. And at that point in time, we're at a 449, very competitive with everybody else in the industry. And we're simply using their current dividend scale and our maximum illustrated rate, which on this policy is 5.60% today, based upon a 9% cap rate. Or is it 9.5? I can't remember off the top of my head, but it's 5.6% is the illustrated rate. The expenses are transparent. We have an expense illustration that can show exactly how much is coming out each and every month, or I'm sorry, each and every year rather. We don't have it broken out on a monthly basis, but it shows it coming out each and every year. So if you want to understand how it works, we have the ability to show that to you. It shows up inside the annual statements for the clients. They can see all of that. There's a lot of flexibility in how you access your cash surrender value. You can do partial surrenders. Unlike a whole life contract, we can only do a partial surrender on dividends. You can only withdraw your dividends, and your guaranteed cash must be borrowed against. Here, you can partially surrender everything. There's no dividend to talk about in this particular case. So this is how it looks a little bit more like a universal life contract. You can have 2 partial surrenders a year. It does reduce the death benefit on a pro rata basis. And I have an example to show you later on as to how that impacts the policy. And it ultimately can't reduce the policy below $100,000 of face amount because that's our minimum face. So if you had a $100,000 face amount and you wanted to withdraw $50,000, you couldn't. You could borrow $50,000, but you could not withdraw it through a partial surrender. Then we have two different types of loans. The standard loan is one that should be familiar to anybody who's used any sort of universal life over the years. Generally speaking, it has a low cost early on. Ours has a 1% net interest cost for the first 10 years of the contract. And then it's a wash loan starting in year 11 and going forward from there. The interest rate we charge is a variable loan interest rate tied to the Moody's Seasoned Bond Index, just like every other variable loan rate in the industry. And so that's going to go up or down on an annual basis. Right now, I think it stands at 4% off the top of my head. If interest rates stay up, it'll probably move up. If interest rates come back down, it may move back down. And we will adjust the rate that we credit to the money that's being borrowed accordingly. So in the first 10 years, if we're charging 4, there's a 1% net interest cost. So we would credit 3. So the client would have a 1% drag on their loan. And then once we hit year 11, if we're charging 4, we will then start crediting 4 on all of that. And that's written into the contract. It's contractually guaranteed. And then you have index loans where the money stays in the index itself and it's going to perform according to the index. And we will charge that variable loan rate. So I borrow $10,000 from my policy and I'm charged 4%. If my index indicates that I go up 8% for the year, I've had a positive arbitrage of 4% on the money I borrowed. Good deal for me. If, however, the market goes down and I go to the 0% floor, which is certainly possible for anybody who owns an IUL today, they might have experienced that in their last segment. I would have a 0% growth, but I'd still have the 4% charge. So a 4% negative arbitrage, bad for me. The index loan by its nature is going to be a more aggressive style loan than the standard loan. It's going to be more conservative, but generally speaking, from an illustrative basis, the index loan is going to illustrate slightly better because the illustration regulations allow us to have a 50 basis point positive arbitrage today on what we're illustrating, our current rate of 5.6 that we're illustrating is our maximum illustrated rate, and our loan rate of 4. We've got to squeeze them together, but we still get to show 50 basis points positive. So it's illustratively better looking. What happens in real life is going to depend very much on what the performance of the indexes happen to be. So I would just describe them as index loans tend to be a little more aggressive, standard loans a little more conservative. So let's move. How might this product work in reality when we start thinking about how we would use this? And again, going back to that 2% non-forfeiture rate that we were talking about, it's an accumulation-based product. So sales sprint number 1, we're going to talk about college planning. Here, our primary breadwinner is a female. She's 33 years old. In this particular example I'm showing you, she has one child who happens to be 3 years old, doesn't currently own any life insurance. Not an unlikely scenario, right? So many people in our line of business, when we meet a client, oftentimes the only life insurance they have is what they have at work. They don't personally own any whatsoever. And so we start talking to them about their future plans. And one of the things she'd like to do is set aside money for college planning for her child. A lot of folks want to do that today if they have that asset available. And this could be a good choice for some or even all of that money, depending on what their goals are and what they want to have accomplished. So in this particular example, I'm showing $20,000 a year going into the policy. And I'm buying the policy on the mom, age 33. I've run into scenarios where we have agents who might want to put the money on the child. I personally would prefer to put the money in the policy on the mom. I mentioned that she doesn't have any current life insurance, and I think that's a key feature here. If something were to happen to her daughter prior to her entering college and she were to die, it would be a great personal tragedy for the family. But it wouldn't be a great financial tragedy because that person's not contributing to the success or failure of the family from a financial standpoint. But if something were to happen to the mom and she didn't have any insurance, well, then that life insurance on the child doesn't do any good whatsoever because who's going to be paying that premium? It is not only a personal tragedy, but it becomes a financial tragedy as well. So I have a tendency to show these ideas where we're putting the money in the policy on the primary breadwinner because so often we find that the primary breadwinner does not have adequate insurance to begin with. And we want to make sure that if something does happen, there's some money there that can be used for college planning. And in this particular case, we start off with a face amount of $383,414. And so if we pay one premium of $20,000 and there's a car accident, we could be paying $383,414 back out to the family. And some of that money could still be used for college planning as we go forward. And I think that's an important differentiator here between putting the life insurance on the child for college planning versus putting it on the primary breadwinner. Going back to the illustration, you can see over on the left-hand side in the green column, that's our guaranteed side. I do want to emphasize, this is a whole life policy. I know we call it indexed whole life. I know I started by talking about the whole life part of the chassis. I know that probably made the impression I wanted it to make, but I want to drive it through because I've talked to a number of agents in our system over the last few months, and sometimes, well, is it really a whole life? Yes, it's absolutely a whole life product. You can see that cash surrender value going up, even with a 0% interest rate. You can see the guaranteed interest rate. That's the very top column of the snip that I have here, says 0%. So there's no interest being credited because of the investment into the allocations to the index accounts. The interest is all coming out of the guaranteed side of the policy. So you've got the guaranteed side growing. That's not the part I want to talk about. Just like if I were talking about a standard dividend paying whole life, that's not really where I would spend my time either. But you can see we've got the illustration here, and we're showing that at the guaranteed side, the illustration doesn't quite work for me. Not a surprise. I don't think it would work for anybody in a dividend paying whole life policy either. But over on the blue side, I'm on my current side, and here I've got 5.6% illustrated rate. It's 5.8 in year 11 because the policy does have a 20-year guaranteed, I'm sorry, not a 20-year, a 20 basis point guaranteed interest rate bump starting in year 11. So in this case, since I'm illustrating at 560, it bumps to 580 in year 11 because that 20 bips is guaranteed irrespective of the performance of the index. And you can see by the time we get to year 10, we've put in $200,000. We've got $212,000 in account value. There's still a small surrender charge on the policy. So $210,455 in cash surrender value. The surrender charge is gone after 10 years. And so now our cash surrender value equals our account value of $224,000. We hit year 15 because our child is 3. So they're going to go to college at age 18. We pull out $50,000 a year to help pay for college. I don't know how much college is going to cost in 15 years. Frankly, my child's going to be 29 in January, so I don't know how much college costs today. I did know how much it cost a few years ago, but now I'm not paying as close attention. But $50,000 a year coming out for 4 years. And at the end of that 4-year time period, we've still got $100,000 of cash surrender value in the policy. We've got a death benefit that's $397,000 at that point in time. And we have, which is slightly more than what we originally started with, at $383,414. One thing I would like to point out is if you look at the middle columns, which I haven't highlighted in any way whatsoever, those are being run at a kind of a middle rate, 2.5% for the first 10 years. And you can see 2.7 in year 11 and later because of the 20 basis point bump that's guaranteed. Even at that 250 rate bumping to 270, we can still have the $50,000 come out. That's one of the things that I like about this particular illustration, how I showed it. It was actually just pure dumb luck. I put in 20, I pulled out 50, and it happened to work that way for me, so I kept it. But it shows how powerful the policy can be, even if we don't have the success of hitting our cap each and every year, which of course is unlikely, or getting the 560 average or what have you. We don't know what that's going to be, just like we don't know what dividends are going to get paid into a regular whole life policy. And so you can see that we've got the 50,000 coming out, and down here you can see not much cash surrender value left, but the policy was able to survive. In fact, I can tell you that the policy will lapse in a year or two because of charges, unless we were to repay some of that money that we borrowed. In this particular case, I was using standard loans for years 15 through 18. And the reason I use standard loans is, as I said before, they tend to be a little bit more conservative. And because they're more conservative, and I'm not paying back any of the loan that I'm showing you, I like that as a go forward. It may not illustratively show quite as well, but I think that's a better choice overall. here you can see that it does on the current side continue to grow. It does eventually lapse on the guaranteed side. It actually lasted until year 31 in this particular example before it lapsed. So pretty good job. But the current side continues to grow. By the time the client gets out to age 85, if they haven't done anything at all, there's a $500,000 of cash surrender value in the policy and about $800,000 of death benefit under the current assumptions. So that's one option. I did mention that she would have the option, of course, to put money back into the policy if she wanted to. And I think that's a viable option here, because once we've paid for our kids' education, what's the next big goal for many of us? Oh, I got to retire at some point, don't I? And I don't have as many years to save as I would have liked. Maybe I need to start putting some money back. So here is that same example, but instead I was putting back a $12,000 loan repayment in years 19 through 31. So we took out the money, and then years 19 to 31, I'm not paying premium. I'm simply repaying the loan. The nice part about that is if I'm repaying loan, I'm getting rid of interest charges, right? And if I'm repaying loan, I also don't have any premium charges that are coming out of the money I'm putting into the policy. So it's straight money going back into the policy that can then grow for me as I go forward. In this particular case, I chose to be a little more aggressive on my loan strategy. I did index loans for the first years 15 through 18 when I borrowed the money. And then I switched to standard at age 65. When I stopped putting money into the policy, I then opted for the more conservative loan option at age 65. But I did put in that $12,000 loan repayment in years 19 through 31. And what you can see is I have significantly more money. Here's $472,000 of cash surrender value there. I'm going to shrink that down a little bit. There we go. $472,000 of cash surrender value and $797,000 of death benefit compared to where I was before. Whoops, I don't want to go page down. I want to go page up. Where I was before was $198,000. So almost $300,000 more by putting in $12,000 a year for 12 years. So not too bad in that particular case. What can I do with that money at that point in time? Well, like anybody, I have lots of choices. The first example I ran is I said, all right, I put in $12,000 a year for 12 years. Let's take out $24,000 for as long as I can. Well, I ran a $24,000 cash flow. It went all the way to age 121, and I still had projected values greater than $480,000 at age 121. So it could clearly, under the current assumptions, continue to illustrate beyond age 121. We just don't run our illustrations beyond that point in time. So $24,000 a year for what feels like probably to that end of that person's lifetime, almost no matter when that happens. Again, unless we have some miracle show up and now we're starting to live until we're age 135 or so. But in this case, we might still be able to get that 24 grand out. What else could we do? Well, a lot of us put money away inside of retirement accounts, right? Now those RMDs start a little bit later than they used to. So maybe we need something to bridge to that RMD. So we'll take out our $75,000 of cash flow. Let's up that cash flow. And we'll take that out. And of course, that's all on a tax preferred basis because it's coming out of a life insurance policy. So take $75,000 of cash flow to bridge my way all the way to age 72 and start my required minimum distributions from my retirement accounts, and then start living off of that instead of living off of my cash flow here. If I do that, I can still have a death benefit of $365,000 at age 85 when my client's likely to pass on. Another option, let's just take all the money we've put in. So all the premium we paid, the $200,000, and then the loan repayments. So that's another $168,000 at age 65. So we'll just take $368 out. And we can do whatever we want to do with that. You know, who knows what interest rates might be? It might be a really good idea to put that in a lifetime SPIA, for example. We don't know what situation we're going to find when our client is age 65, but what we have done is put them in a place where they have options available to them. And so if we take that $368,000 out and they do whatever they want to do with it, at age 85, we have a death benefit of $610,021 on a projected basis. All right, sales sprint number 2. Just call this lump sum at retirement. It's pretty simple, but I like the idea. I've seen people use this. I've talked to agents who've used this. I've got a male, he's 44 years old. He's a preferred non-smoker. He needs $500,000 of death benefit now because he's got a family to support. Primary breadwinner. We want to make sure we have some death benefit in case something happens to me now. is interested in a limited payment structure. I don't want to be paying premiums for the rest of my life. I want something that's simple, get it done. I have the money to do this. We talk a little bit about our accelerated benefit rider, which can provide a chronic illness benefit for the client or a terminal illness benefit for the client if they need it at some point in time. And I'd like some money at retirement. If we could make that happen too, that'd be great. What can we do here? Well, there's lots of different options, but I think, again, this is a good place for that indexed 10-pay contract to fit in. So here's a quick example. This is a $500,000 policy on my client. And we can see we're putting in $33,450. So it's a pretty steep premium for that $500,000. And you can see how it impacts the policy. By the time we get out to year 10, we've got $356,000 of account value and $353,970 of cash surrender value. By year 11, we're at $376. So we're clearly above break even by the time we're at year 11, or by year 10 rather, and then it continues to grow thereafter. One thing I didn't talk about, but because we don't have dividends, you'll see this is a little different from most whole life policies. The death benefit remains level until you hit corridor. This is a cash value accumulation test policy, just like every other whole life policy. So once it hits corridor, which means your cash value has risen to the point where you need a higher death benefit, you can see that the death benefit rises up very quickly compared to other dividend paying whole life policies from pretty much any carrier. By the time you get to year 13, 15, you're going to find that our death benefit is every bit as attractive as theirs happens to be. They might have a little bit of edge in year 6, 7, 8, but then that changes pretty quickly thanks to the corridor test on a current basis. So we put in the 33,450. We get out to age 65. We hit retirement. My client says, I'd like to have the money. Good. Here's $334,500. You put it in, you get it out, you do whatever you want to do with it. And then we still have roughly a $500,000 death benefit at that point in time, which is what he wanted. And on a current basis, it's going to continue to grow throughout the rest of his life. I did, and I want to pause here for just a minute because I want to point out to you that I took out $334,500. But if you look at my death benefit in the far right column, the year before the surrender, I had $954,000. The year after, I have $483,000. A difference that is significantly more than the $334,500. When I talked about getting money out of the policy, I said partial surrenders will reduce the death benefit on a pro rata basis. And that's what's happening here. I did that as a surrender instead of a loan. I did that for a couple of different reasons. One, I wanted to show you what can happen to the death benefit when you do a surrender. My surrender was for roughly half of my cash value as of the end of the prior year. And so it's going to reduce my death benefit by roughly 50%. And you see that happen right here, and then it starts to go up again. But I do think that you have options here when you think about how you want to get money. If I take the surrender of $334,500, one of the things I'm avoiding for my client is any interest charge on the policy, right? Even a wash loan, a standard loan, is still building up an interest charge inside the policy that has something of a drag on it. An index loan, it can be an even bigger drag if the performance doesn't bear out. So if you were to take a loan, if you were to do a standard loan, what you find is by the time the client gets into their early to mid 80s, it actually, by that time, that interest drag is starting to hit the death benefit a little bit more than the surrender did. That the surrender actually is outperforming by the time client gets out closer to life expectancy and beyond. So if I have a client with really good family history who happens to be healthy, I might recommend a surrender, even though it hits the death benefit harder than a loan would. I'd probably show them both and explain why I recommend the surrender, because I just would want to make sure that they understood the decision so that we didn't see lawsuits in the future in case something untoward happened. So let's try to always be careful about that. But that's the difference between surrenders and loans. That any type of loan, even a wash loan, does create some sort of an interest drag inside the performance of the policy, which a surrender is never going to do. The surrender is simply going to take that money and it's gone, and it may have a larger impact on the moment that you surrendered the policy, but it may not have that same impact. It may be a better choice over the long term, and something you should just be aware of. I don't know that it's terribly important because the differences aren't vast, but I do think it's important to mention it to you if you have some interest in the policy. So where else could we use the policy? Well, here's a good example. and not one we see as much, but I think is something that can work. I've got a grandmother. She's 69 years old. She's got a pension and Social Security income of about 58 grand, financial assets of $1 million, doesn't have terribly high expenses. They're lower than her income. She's got a couple of grandkids she'd like to do something for. When I was growing up back in the 60s and the 70s, grandparents didn't have as much money. Some fabulously wealthy ones did, but as a country, we've become much more wealthy in the ensuing 50 years. And so we wouldn't have seen our grandparents do something like this for us. But what we have found is that many grandparents are interested in making a financial contribution to their grandchildren in some way, shape, or form. And then sometimes that takes the place of a permanent life insurance policy. This could be a great policy for that. If you look at the left-hand side where I've got it marked in green, the terms of the payment are guaranteed. My client is 69, the grandmother, and she's likely to see her gift completed in her lifetime. She'll probably make it to 79 if she's in reasonable health. Most retirees now today are making it out into their early to mid 80s, even into their 90s. My mother-in-law happens to be turning 97 in January, and she's still living in her own home, God bless her. And so these things happen. And so she might be interested in doing something like this, where we'll just buy some life insurance directly on the grandchild. Now, who owns the life insurance? That can be an interesting question. Obviously, the child can't. In this case, I used an age 6 or age 5 child. They can't own the life insurance. So either the parent is going to have to own it, or the grandparent, or you would put it in a trust. The one thing you always want to be careful of when you're looking at life insurance is you want to steer clear of the Goodman rule. And if you've heard the Goodman rule, you know that on a life insurance policy, you want to be careful that there aren't 3 people involved. You don't want to have a different owner, beneficiary, and insured. So if I were to buy life insurance on a grandchild, and I might be the owner, and I might make the parents the beneficiaries, that could make the policy taxable on the death benefit. So that's not a good place for us to be. We generally want to have the owner and the beneficiary be the same when the insured is other than the owner. So I would suggest that in this particular case, I would either have the parents be the owners and the beneficiaries, or have the grandmother be the owner of the beneficiary, or put it in a trust. And you can plan how to get it out and give it to the grandchild in the future under the gifting rules that we have in place. Certainly not going to be a problem with current gift tax capability to get the money out get the policy and give it to the child at some point in time when they're of the age of majority. On the blue side, you can see we've got premium recovery that we have had in the other cases. On the current basis, she's put in $50,000. By the time we get to year 10, by the end of year 10, we're at $51,000 in cash surrender value and in account value. Shoot, by year 9, in fact, we've got premium recovery because our account value is at $45,244, and we will continue to see growing cash value and death benefit thereafter. What can a child do with these assets? Not up to me to decide, right? I mean, this is money that could be used to potentially help with a college education, but that's not required here. It's money that could be used for down payment on a home. It's money that could be used to start a business. It's money that could be used for anything. It also gives them a permanent death benefit, which is a great place to start anyway, because with a permanent death benefit, you don't necessarily have to worry about buying life insurance at an older age where it could be much more expensive. There's lots of good things that can happen for a child who has life insurance on their life as they go forward. And it doesn't require that we put in huge sums of money. Here, I'm simply talking about $5,000 a year for 10 years in this particular case. At Ohio National, we do require that the primary breadwinner for the family, so not the grandmother, but whoever the child's primary breadwinner happens to be in their family, have twice the amount of insurance on their life than the child does. That insurance doesn't have to be with Ohio National. It doesn't have to be permanent. It could be term, but in this particular case, since it's $149,831, we'd want to see about $300,000 of life insurance as a minimum on the primary breadwinner for that family, whoever that happens to be, husband or wife. Doesn't really matter to us, but it does matter that they have that on them. And I'm pretty sure that most other carriers have some sort of limitation on what you can put on a child in comparison to what they have for themselves when you start looking at the parents. I do want to mention our website, iwlforlife.com. We've put a bunch of information out there. There are additional sales ideas from our advanced planning team, as well as for people in our product marketing department. We have some podcasts out there. Well, you can see the first one up there is Momentum Podcast, How to Use IWL. And I happen to be the guest. So I really encourage you to listen to that one because I understand the speaker is excellent. You have, it works. It's easier for me when I can see my jokes actually land on a live audience. It's a little harder when we do webinars. We have competitive data out there. We have some social posts out there for you to look at. And that can be used. There's no firewall here. I'm certain that most of you are not licensed with Ohio National. And so therefore, what I would say is if you're interested in the IWL product and you'd like to learn more about it and maybe talk to somebody at Ohio National about whether or not you want to be contracted with us, at the bottom of IWL4Life.com, there's a link to joinohionational.com. That will get you in touch with our local regional officer, and they can talk to you about anything you'd want to know outside of the IWL that we're talking about here today and how it can be used. But this is for the most part all agent use material. You can see in the upper right-hand side, we have some tests, some trial illustration software that if you're interested, you could download and take a look at it and compare our policy to some of your other whole life policies you might have used as recently as yesterday, and compare it and take a look at it and learn how the product works. We'd encourage you to go ahead and do so. In addition to IWL4Life.com, which is for you, the agent, we also have IWL4U.com, which is for your customers. This is client use material. It's all approved for use with the public. So talks about how you can use the policy. So this is anything you'd want to see regarding something that your client might choose to use. You could even send a client here if you wanted to, because all of this material is approved for their use, and it gives you a good idea of how you could talk about the product or various choices you might want to make when trying to size up whether or not it fits for a particular client. I started this webinar, my title slide said next stages, but that wasn't really what we had put out in the advertisements for what I was going to talk about. We used a different phrase, and that phrase comes from a guy named Wayne Gretzky, and it's one that has stuck with me my entire life. He was once asked, "How are you so much better than everybody else?" I mean, he was called the Great One long before he ever got to retirement. He was such an unbelievable hockey player, and his answer was simple. He said, "I skate to where the puck is going, not to where it has been." And I'm going to go back, do a callback to the beginning of the presentation when I talked about interest rate environment. I don't know where the interest rate environment is going to be in the future. I know that what I've seen in the last dozen years, 14 years since 2008, is a commitment by the Fed to keep interest rates low. And as they are ratcheting up the Fed funds rate, you know that their goal here is to bring the inflation rate back under control by making money much more dear than it has been. I grew up and became a young adult in the time when interest rates were higher. You know, my first mortgage was 7%. So when I hear how awful 6% mortgages are, I think, well, I don't think that's that big of a deal. But I also have been a beneficiary of falling interest rates over time. I would encourage you to think about the ability to leverage interest rates through index performance in the future. If you think, as I do, that interest rates in the US and globally are going to go back to where they've been over the next 10 to 12 years, where we might see an average rate for a triple B bond at 4%, then I would suggest to you that it's going to be harder and harder for a dividend paying whole life contract to be able to perform effectively in an accumulation and distribution role, because it only has interest rates to work with on a long-term basis. But if we can match those interest rates and pair them up with the potential performance inside of an index that's tied to an equity market, we have the ability to leverage that interest rate into something higher. That's why I titled this in the advertisement, skating to where the puck is going. This isn't where the puck has been. The puck has been where interest rates have been really important part of our business. But just as the declining interest rate environment has made current assumption UL much less attractive in our industry and a policy that is very rarely sold in comparison to where it was 20 years ago, it will ultimately have that same impact, I believe, on dividend paying whole life. And so where IUL has picked up where current assumption UL left off, I think IWL is going to pick up where dividend paying whole life has left off. And we're going to see that as we go forward in time. I've got my company thinking about skating to where the puck is going, not to where it's been. I encourage you to think about it the same way. With that, I'd say thank you. And if we still have time, I'm not sure where we are. I guess we have a little bit of time. John, if you want to throw a question or two out that you think is particularly relevant, I'd be happy to answer it.
So Carl, we only had one question that we didn't get to that we weren't able to answer during the session. I'm not sure of the answer and haven't been able to find it yet just because I am not as familiar with the underwriting side, but the question was, is this available for non-medical underwriting until certain death benefit amounts?
No. So yeah, we have the answer is sort of, I guess. We have an accelerated underwriting program from ages 18 to 45 up to $2 million worth of death benefit. You can go through that on a non-med basis. The pass-through rate is pretty high on that. It's about 80%, but it's not guaranteed. If the underwriter sees something in the application that suggests that we need to take liquids, blood and urine, or that we have to, when we do reserve the right to get an APS, we can do that. Typically in our accelerated underwriting program, about half the cases get through in, I believe, 5 days or less. About half take a little bit longer. It's much more abbreviated than the full underwriting, but as I said, only about 80% go through that. About 20% for a variety of reasons get kicked back out to full underwriting. So there's no guaranteed non-medical on this particular policy.
Haven't seen any other questions come in, Carl, that we haven't already answered.
Okay, great.
Okay, wonderful. Well, thank you so much, Carl, for joining us. As we said at the very beginning, if you missed it and you joined a little bit later, all the questions and answers that we have covered will be in our follow-up email along with a survey. We would love for you to take that, please, and get some valuable feedback for Carl and John and Ohio National. And we appreciate you joining us here from NAIFA and our advisor today. Please feel free to look and understand NAIFA and see if you want to. If you're not a member, we please encourage you to join. And then if you are a member, we please encourage you to get more involved and advocate, because we do have a new 118th Congress coming in, and the size matters and having those relationships matters. So I hope that you enjoy today's episode of Advisor Today. We look forward to seeing you on upcoming events. You can always find that at at.naifa.org. And again, Carl, John, thank you so much.
Thank you. We very much appreciate it.